You're about to find out on our next discussion here, which is aptly titled, Are LPs Getting What They Want? So I would like to welcome to the stage the moderator for this panel, Jolyon Horsfall, who is the CFO and co-founder of Flight 3, and he'll be walking you through that answer. Was it the Genius Act, or is it just LPs not getting what they want?
Wow, welcome. Firstly, thank you so much for Paris Blockchain Week for putting on an amazing show. It's been start to finish just fantastic. Today we have got a star-studded panel for you with some real experts and a brilliant mix of experience, which is going to bring a great conversation. We're diving into the topic, performance over hype, what LPs actually want. It's an ever-changing landscape. So without much further ado, I'll let the panelists introduce themselves. Brian.
Hey everybody, my name is Brian Wong. I'm the co-founder and general partner at a fund called Ascii Ventures. For those of you nerdy enough to know what Ascii is, come talk to me. We back exclusively boring tech companies, so companies that are behind the scenes, picks and shovels. We're well known for backing a company called DD.XYZ. This is for due diligence and ratings on chain. And we also have a pretty unique strategy, which we'll talk a bit more about in the questions, where we have a second part of our fund that's focused on just secondaries. So we look at companies that are 15 billion plus. So anything 15 million and under, and anything over 15 billion.
Amazing. Dan.
I'm Dan Held. I've been an operator in the space for about 15 years, including stints at Kraken, where I was CMO, and at blockchain.com, where I led product back in 2014. This is my VC era, to where I am investing in Bitcoin DeFi. So Bitcoin DeFi would be Bitcoin L2s, meta protocols, all the cool stuff you see happening on Ethereum and Solana, trying our best to bring that back to Bitcoin. So that's what I focus on, and I'll hand it over to you.
Hi, everyone. I'm Harald Eltvedt. I'm one of the operating partners at Ascii Ventures. We're the corporate venture arm of a big corporate bank, Standard Chartered Bank. So I'm probably the more institutional voice on the panel. We've been in crypto and digital assets for close to 7 or 8 years now, but mostly with an institutional lens to what we do. So we built a custody platform, a market-making platform, recently a tokenization platform in Asia, and a very exciting prime brokerage business that we're about to launch as well, and a number of other things.
Hello, everyone. I'm Nataniel Elkaim. Thanks for having me, or actually, I should say thanks for being here, because I'm one of the organizers of this event. I also used to run a VC fund. We back early stage crypto companies targeting mass market, very early, sometimes even angel round. And eventually we've built a second fund a year ago, which is now focused on DeFi. So more liquid strategies, which I'm sure we'll have the chance to discuss about.
Amazing. Now it's time for the hot takes. But I think, starting off, almost like a definition, it's been changing so much. What does performance actually mean in this day and age? What do you guys look for, and what does that actually as a benchmark mean?
You mean for LPs or for the companies we're looking at?
Both.
Well, for LPs, obviously, it's DPI. But for the companies we're looking at, it's the moat that comes from go-to-market, right? So I think right now the issue we're seeing is code is rapidly sort of disappearing as the moat. Like the technological moat does not necessarily apply with the code you're creating. It's more going to be in the go-to-market and the customers you bring in very rapidly in the very beginning, and then having that very big focus. But that's a two-parted answer to your question. So.
As an operator, of course, I look for those qualities that I had and did not have. There are characteristics of founders where these are founders that are going to pound their head against a brick wall till it turns into dust to get through that wall, to get through whatever friction, moat, or any sort of issue they're having. So for us, it's very founder-centric. We also invest in earlier stage deals. So there's not a lot of signal there in terms of its pre-product. There's not a lot to evaluate from sales, product, et cetera. So we're really founder investors. So early stage VCs typically just look at that founder dynamic, and then do they synthesize and think about their problem set? So have they identified the right problem in the market? Are they building the right solution for that problem? So for us, it's very heavy founder mix combined with their ability to go see into the future?
Yeah, I would agree. I would say all of the above, and I'm going to add the boring part, which is a good understanding of risk rewards. I think it's not just about what you promise your investors that you're going to bring, but it's also understanding all the risk-related activities and whether or not you have a capacity to speak to regulators and conduct regulated activities. So I think these qualities, back to what you were saying about founders, are also very important. Understanding actually what you can and cannot do is important as well.
And if I had to add something up from an LP perspective, I think liquidity has been a key topic recently in terms of how fast can you deliver a return to those LPs, because of how crypto structure is and how inherently speculative it can be. Like a early stage company launching a token after 3 years, that could be mind-blowing for typical VC, which usually waits 7 to 10 years. And I think that most of those projects are now thinking on the longer term. But yeah, liquidity would be, I think, a key topic for LPs.
Yeah, and I think you touched on structure there. There's a narrative going around that sort of LPs want structure. We've got some amazingly different structured funds here. What does that structure look like? What are we moving towards?
Yeah, I know you didn't want the whole thing, so I guess maybe you start, and then we'll change the sequence.
Yeah, a little fight in between.
I'll hop in with a kind of a controversial take where I believe the whole hybrid structure where you had a venture fund and a liquid fund, I don't think that's the right way to mix those two sort of strategies together. One, you've got a classic asset duration mismatch problem. If you've got LPs that can redeem on some sort of shorter term basis, like within a year or two, and you invest in venture capital, which is a 5 to 10 year horizon, you're going to have a classic asset mismatch problem. Also, there are very different strategies. VC is a very far-looking, long, arduous sort of, I would say, slog of a journey versus, hedge funds actively change their perspective on the market. They engage in different strategies. So there was a narrative for a while in crypto that you could have hybrid funds, and I think that narrative is kind of ending, which I think is a good thing.
Yeah, I think, and thank you for not saying you don't like our strategy, but this idea, as a GP, you face this constant tug of war of like the LP expectations on liquidity and DPI, and then you trying to get return that you recognize because you've seen it and you want to wait it out and you want to play the patient game. And then also the sell used to be to LPs, hey, you can insulate your money for, a decade plus and then things are good. But now it's no longer, it's like, wait, decade plus means more 15 years, and then also this liquidity you promised is now only coming from sort of crazy venues like SPVs and secondary markets and brokerages and all sorts of things. So it's like not as straightforward as it used to be. So for us, it was thinking about catering to the LPs that have not been exposed to venture before, finding a timeline that is going to be exclusive to that asset. So of course, secondaries would be, pre-IPO companies 2 to 4 years away from IPOing. So we forecasted 2 to 4x within 2 to 4 years. But then venture, being early stage, how can you return faster? So here's where we thought through a different model. And this is actually talking back to the founder profile. We specifically have prioritized looking at founders that actually worked at an incumbent, is building a product to solve the problem for that incumbent, obviously have left it now, and may likely be acquired by that incumbent. And I think right now that is one of the few things that as a moat for a founder is valuable, because you spent time, especially understanding, let's say it's regulatory more complicated. You spent time at a bank, for example. I'm not saying you would leave Ascii, but if you did, it would be like, I've been there for a while. You know what the complexities are, and you can build a product to sell back to them. And that might actually shorten the timeline. So as a VC, the power laws have changed in that, when you look at those kinds of founders, it may not be the crazy unicorn win. It's going for a third base hit, to use an American analogy, or like just base hits in general, that can return more quickly on the early stage venture profile. And then you have that combined with secondaries that creates a bit of a timeline thing. So for us, it was an experiment, admittedly it is, on timeline, sort of morphing, and how can we change that expectation of timeline by finding those kinds of profiles of companies.
Yeah, I would say in my case specifically, we are also in the game of getting the bank to adopt a lot of the ventures that we're either creating or that we're backing. So it's not, necessarily the long game that you were talking about and seeing what's going to happen in 3 to 5 years. We actually want the ventures to be deploying their capability for the bank and or for the clients of the bank, right? And so there's right away a commercial use case that we need to be able to demonstrate. So I think for us, it's creating that instant commercial opportunity, which is extremely important as well.
But that should be always the lens, I think, is the commercial viability, and that's why when you have people like you have worked at, these exchanges, immediately, okay, would I even buy this? Would I be a customer of this? At least it gives you that initial filter and lens, which is always great. And I think that's really what we need the most of right now is that commercial viability lens right off the bat. Because again, I'd rather you burn the million figuring out that one wedge and getting those first few customers in than to be too general. I think the danger of generalist businesses or like more horizontally applicable early stage businesses right now is that you could die trying to figure out your use case versus just making that bet in the very beginning.
There you go. And one huge paradigm shift that's been coming is AI, and I'm sure you've probably heard it 10,000 times daily. What are you guys actually on a day-to-day basis, thinking about it, doing? What are you future-proofing with it?
Actually, I figured AI would be, is very interesting in our day-to-day, well, maybe on the administrative part, of course, maybe that's the case for a lot of different jobs that are services related, but also in the way to be up to speed on the tech. So I think it helps a lot on the decision making to get great elements of context, especially when you go into niche technologies or niche ecosystem and you want to know who are the players. On our side, we've been playing with Claude, OpenClaw as well, and different models. And sometimes you can just drop like company name and you will have a full analysis of the markets. And that's, I think, super powerful because it gives you a signal. Obviously, it can be biased, there can be noise, so you have to do your research from there. But I think it saves tons of hours from a VC perspective. And I could even add one element is that as we organized the startup competition of Paris Blockchain Week, we went to over 1,000 decks that we received over the past months. And AI was critically helpful in making it possible for us and partners to review the company, just to organize themselves, to make it clearer, instead of going through every specific deck one by one and getting some help on that side. So I think that really is the VC approach in the first break.
I'd say, yeah, on the VC side, a note to founders, don't have AI build your deck because we can fucking tell. We always know. There's a bunch of 100%. So look, if you want to have AI do a first pass on your deck, totally get that. I think it's smart. But you need to have the human touch in every single slide. The continuity of your narrative through those slides of both the problem you're solving, the team, et cetera, and the aesthetics. Yeah, sure, AI can do a first pass, but it needs that human touch. So please, we can tell, spend the extra 12, 24 hours to go work on that. I know it's laborious, but it's something we notice. I think on the VC side, we obviously are going to throw in a deck into an LLM and have it spit out a first take. I think the associate level, so I think most of us here are GPs, but on the associate level, I'm assuming my associate's going to do that for sure. Now, I expect them to spend more time and do a thorough deep dive, but at a minimum, it's a nice hot take on what's the TLDR of this deck. Granted, a deck is so short. Most properly created decks, like if you look at the 500 startups, how to build a deck sort of template, they should be under 10 slides anyways. So you don't really need that much of a synopsis from AI. TLDR, we're going to probably throw it into an LLM to get a hot take. At the same time, an associate, or if there's no associates, a GP is going to go and really evaluate it. So I'm not sure how much automation it really does. Outside of that, it might be more of like us trying to look at, find me the top 10 competitors for this company so I don't have to go dig through Google. So that's where it's been most useful so far.
Yeah, so I think what you're describing is AI as a tool to get better funding for founders. We look at AI from a business model perspective as well. I think what it can do better, either from a productivity gain or from a capability. So some of the ventures that we're looking are around agentic payment or agentic wealth, for example, which we think is going to be the future of how people want to transact, how people want to invest. So there's a lot of things that we're looking into AI as a business model. And I would say even on the risk, again, just on the risk framework, how can we do what we call KYC, so onboarding of customers, understanding how we can make the experience frictionless, et cetera. And I'll just give another example. So we're mostly a bank in Asia, in Southeast Asia, and Middle East and Africa, but we created 2 digital banks, one in Hong Kong and one in Singapore. If you compare the 2 digital banks that we created to the traditional bank that we have, it's a lot more digital. It's 300 people that work for the digital bank. We're now thinking of an AI native bank, to launch an AI native bank. And you could really think, you probably wouldn't need 300 people to run the bank. You probably could need 3 to 30 people, right? So that's the kind of scale I think that AI can bring as well.
It's made it a lot of fun, I would say, right? And then yes, on echoing it, like over-reliance on AI and the human parts is very much so something we would warn against. Within the businesses, though, I will say and throw this out there that mediocre AI applied to an industry from people who understand the nuances of that industry and solving it. For example, we've taken pictures from everything from a company that's doing welding fault detection. So they use sonic detection of faults so that you can re-weld preventing re-welds. We looked at a company doing AI material sciences for just battery tech. There's a lot of different very specific verticals that we've noticed where, again, the generalist LLMs are meant to be the platforms things are built on, the application layer, and then the service layer. So I wrote a post about this recently because a lot of my LPs were like, what about this SaaS apocalypse? My portfolio is getting corrected. This doesn't sound good. Where does SaaS go? I think SaaS transforms with AI into actually services businesses, which we go full circle because, as you know, VCs used to always poo-poo on services businesses. But I truly believe that now, because of agentic, you can bake in the services and become the service itself. And when you service a particular vertical, then you're basically consulting them on what that orchestration of potentially a bunch of agents could look like, how that interacts with your platform, but all of that becomes almost full service, and you can do that in a scalable way. And again, back to my point about it applying to the vertical, servicing in that vertical is going to be the way that you win. So that's how we see some of that changing and why AI has made it more exciting. But again, AI being the only thing in your pitch will probably be tough. Again, the wedge coming into the segment and having that segment locked down and the use cases where you've nailed for that segment is still the key.
Yeah, and you all mentioned AI's helping with the TLDR and these sorts of things. Good judgment has never been more important. Do you think if everyone's just getting the same LML take on a deck, that you're going to potentially miss that 1000x outlier?
Yeah, I mean, look, AI is still pretty shitty, to be honest. Like, it hallucinates all sorts of crap, and I think in both a professional capacity, like if you're an operator, like let's say you're a marketer, product manager, engineer. Engineering, I think, is a little bit more practical because you can go run and check these different scripts and check the code. Whereas like a marketer, I haven't seen anything that's like ultra revolutionary yet. Like, sure, you can generate commercial grade, copy and creative, but they found that the click-through rate on AI generated creative is lower. So, there's all sorts of like, oh, we could shortcut things, or oh, what if we had AI, run our Google Ads campaigns? Cool, until it accidentally allocates a couple 100,000 buying who knows what. So, yeah, you still need that human touch. Now, in the next 5 years, 10 years, I mean, it'll be really, really good. But right now, it's still pretty rough.
Yeah. So
I have this controversial take too that AI is intentionally dumb right now to train us to check it. Because I think as a human, not to be too philosophical, but as a human race, we should be trained at least in the habit of checking the work. And I think checking the work is still one of the most valuable things we'll be able to contribute to this, workflow, no matter what, right? And I always tell folks, like, there's like this devil and angel on your shoulder when you're like thinking about a task. Like, should I just have the initiating of the idea or that genesis of the idea be an AI thing or me thing? It really should just be a you thing, because that's the only thing we're going to hold on to as a human race when all is said and done. The generating of a truly unique idea that's not influenced by patterns or pre-trained models is really where we're going to be unique. And we should try not to over-rely, because this will create a habit of letting it do its thing without ever checking it, which is the most dangerous thing I think we would ever end up doing as a race.
Totally. Professional skepticism has never been more needed. You know, when you do the ACL, become a chartered accountant, you just get that nailed into you. Don't trust anyone's work at all, ever. When you're doing audits, you have to just I don't trust anything that you guys have done. And I think people need that for the AI. So it's 2026. I'm an LP. You know, historically, some of these crypto VCs and funds have massively outperformed. The tide is potentially changing. Are crypto native VCs losing out on edge to traditional? Am I putting my money with Harald? Am I going with right? Who am I going with? What should we be thinking of? Is crypto native dead, or is it going to make a comeback?
I mean, it's a really tricky vintage, right? Like all the 2021 through 2024 raised, funds that deployed in 22 to 23, 24. That vintage hasn't really been fruitful. So, that certainly is a bad omen for, I would say, the VC sector, crypto native VC sector, as if you're exposed just to crypto and the last funds that were raised and deployed aren't fruitful and they haven't been harvested, it's going to be really difficult raising from LPs again. So right now, who knows what sort of market we're in? Bitcoin could be above 100,000 by the end of the year and everything's back on, or more. Or it dips. But, I think it's just really hard to tell on VC, and that's why these funds are 7 to 10-year horizons, because you just don't know how to play out. So right now, not looking good to raise another fund if you were going to do that. However, things can change quite rapidly, and market sentiment would shift. LPs might be interested again.
I think maybe just on our side, our fundamental belief, and that's how we started in crypto for a bank. I think we're one of the first banks actually to be very, very bullish on crypto and digital assets. But our fundamental belief day one was digital assets are here to stay. And we didn't really believe or understand the segmentation between DeFi and TradFi, because what was interesting to us was backing an asset class that enabled 24/7 transactions, transparent transactions, understanding the source of where these transactions were going, were flowing, etc. I think we're, as a matter of fact, going to see a lot more institutionalization of this asset class. You're seeing ETFs are a big driver actually of digital assets, and you're going to see a lot more traditional assets going on chain, a lot more stable coins. We just launched a stable coin in Hong Kong, as a matter of fact. And with that, really stabilizing, I would say, the volatility, which is a driver of insecurity for people. So that's our belief.
I think to Harold's points, that is really good on the approach to what it enables for LPs. It speaks loud on what are all the tools available to those LPs, because your question is, what should we pitch to an LP in 2026? And I think the question is, well, ultimately, what typology of LP are we thinking of? Because based on the LP interests and needs for liquidity, for return, appetite for risks or not, I think crypto has pretty much, as of today, anything to offer, or it's actually being built. Because with crypto, you can get any kind of exposure. There's obviously the VC part to early stage companies to try to get asymmetric returns that way. But right now, given all that was built or being built, you could have, exposure to, a ceasefire in Iran, for example, through Polymarket. Crypto enabled that. You could have exposure to a book of loan. Crypto enabled that. You could have exposure to just Bitcoin long through an ETF. Even being an institutional, this is something that you can put in your own book now. You can have long-only exposure to delta-neutral option strategies on crypto. Now you can even do it in DeFi. You can have yield exposure to DeFi markets. It's still nascent, and it still finds its way on the map, because we have a very hard time, I think, being able to categorize or approximate the risks involved there. We can see what happened in the last weeks with Drift protocol hack or Resolve hack, and this are black swans. So I think as much as the space evolve and as much as we can see indeed maybe some VC funds outperforming the market because of maybe too big of an interest, launching VC funds and backing early stage companies, the market kind of reacts by enabling very different source of yield or returns being available to LPs based on their need.
This was part of the evolution. I think the vintages we're seeing, it is all the learnings, right? And it's almost, when you say crypto native fund, it's almost akin to saying like internet native fund in like the 90s or whatever, and then, you know, mobile native back in the 2010s. This is all part of the learning. At the same time, there are people that kind of ruined the fun. I won't name them, but also people that made, you know, eye-watering amounts of money, which also ruined it too, because then the expectations are insane, right? So you kind of try to take the outliers, explain that logically to the LP, the type of investing they're trying to do, where their risk profiles are, of course, and we can't homogenize that group and assume they all have the same objectives, because they don't. That's all pretty critical. But my whole, you know, thing here is, at least the policy we should always take is there's going to be these, you know, when you look at the blockchain as a technology component, there's the gambly kind of, you know, temporary ARB kind of business use cases that you can invest in, and even the asset classes and the exposure itself, like prediction markets and whatnot. That's one flavor. And then there's we're using the tech because it's going to be needed for our damn business. Just knowing that eventually all money would be moved in one way or not, visibly or invisibly, on blockchain rails or with stablecoins and whatnot, is critical. And that's why we're betting on stablecoin app layer. Infra, again, has been around, will continue to grow. Too expensive for us to buy in. We know the profile of our fund. We're not that big. But you look at app layer, it's like, well, that is really where the magic is going to be. And the beauty of that, too, is there's no innovation needed there. Like, you're just taking stuff that happened in TradFi, let's say payday loans, right? Neobanks cater towards, you know, OnlyFans creators, whatever it is. Not that there's a TradFi use case for that, which is, again, one of those parallels we are bouncing into. But thinking about those kinds of use cases and then knowing that the app layer is where money will be made because of the need. The customer need is there. That is where I think we should always be reducing our theses back to.
Yeah, and so you have seen some outperformance. Let's say Dragonfly raised their $650 million fund. If you had to sort of boil it down to one sort of key characteristic that helps something like that happen or outperform or successfully raise in this market, what do you think it would be?
Hasib? I mean, it's like one guy. I'm kidding. But it's like also his previous LPs compounding the amount that they've made and bringing it into this next vintage. But, I mean, I don't know if you guys have other comments on Dragonfly.
Or just how you'd successfully raise from LPs. Like what are some of the
make them a shitload of money the first time or second time around. Yeah, that's pretty much it. Yeah.
I mean, we like to say that previous performance doesn't reflect for future performances, but when you speak to an LP, ultimately you're facing another human, and the bits of data available are the previous ones. So I think the track records play a huge impact when pitching an LP on being able to raise a huge fund. Obviously, when you're at 600 million to fund early stage startups, it asks us ourselves on how to return that funds. And historically, Dragonfly made a lot of money backing layer ones and layer twos. But I think in crypto, this is a meta that has kind of changed, because now we find ourselves with hundreds of layer twos that sums are very poorly performing because of just nothing happening here. And to your point, Brian, I think the application layer is what we're missing. So maybe pitching something in not being hybrid in terms of liquid and VC, but hybrid in terms of infrastructure and application layer might be a good mix, because ultimately that's what enabled the kind of returns those funds were able to provide.
I think, you know, in our case, just reacting to what Brian was saying, I think explaining the outliers, we're not in an outlier business. It just doesn't work like that. Actually, there's a method to the madness. And I think what you need to do is really understanding your, you know, what you stand for, your values, your mission, and so forth, and just finding LPs that align with that value. There's no point in just raising money for raising money, because ultimately you will be in a conflictual relationship with the people who don't align with your strategy, with your mission, and so forth. So I think that's really critical. I know money is very attractive, but down the road it could, you know, bring a lot of problems.
my favorite learning, because I've been doing this, I'm relatively new, so I'm going to learn from you guys, but a lot of the LPs, when you take track record to them that you've done yourself, let's say as an angel, which is what I did, they're like, that's cool and everything, but that wasn't your track record with me. And I'm like, okay, there we go. Well, then you can play ball now and be a part of this if you want to. So there's like this funny thing, I was like, well, you did not make that money for me, you made it for yourself. And at least there's a data point, but of course a lot of it's relationship and trust driven. I'd say most of our LPs I've known for 10 plus years, and a lot of it is knowing that you'll do right by them. And so I would say of all the businesses that are going to be torn apart or ripped to shreds or evolved because of AI, any kind of relationship driven game will probably not. And one of the final DD items that we have is we have to meet every founder in person. So I will fly to you if needed, and that is a critical part of our DD because, on paper, things might look amazing. You might have had the best calls ever. It's sitting down and looking them in the eye. And really what we're looking for in that eye contact, as romantic as it sounds like, is are you going to be able to put up with the amount of shit that's going to get thrown at you, right? One of my good friends, Mike Lazaro, he wrote this book, Shoveling Shit, which is like the name of his book about being an entrepreneur. And the tenacity and resilience component is really only something you can detect in person. I truly believe. There's no way you can find out through a bunch of emails or how annoying they are on LinkedIn, because that's just easy. You're just like behind a screen, you're like a keyboard warrior, being like, hey, you did read my pitch. But like when you're meeting them in person, it's a totally different vibe.
Yeah, I absolutely agree with that. I mean, this isn't part of our formal due diligence process. However, most of the time, we've probably had dinner or drinks with them at some point, seeing how they carry themselves in a conversation. Are they convincing? Are there other people at the table that they've convinced about their idea? Do we see the other person being convinced? They have to be a natural storyteller to both attract capital, talent, and customers. Yeah. So, they have to be a great storyteller. They've got to be charismatic. The charisma doesn't come through digitally. You've got to see it physically. And hell, I think the game we're in is kind of the game of tea, gossip. Part of it is we hang out with these founders, we hear about how they view their competitors. Then we hang out with their competitors and see how they view that other company. And then we're all together out late night, 2 a.m., hearing what different founders think about each other. And so, for example, there was a really good example. This would be like ETH Denver 2024, 2025. There's a place called Ordinal's House for the Bitcoin DeFi sector, which is what we invest in, a really niche category in the space. That was the house where all the founders hung out. We were the only VC there, so we're there having beers, hanging out. We were finding signal. You were hearing them debate each other about different things, and through those moments, you see who kind of rises out of that as a really good founder. But yeah, it's really that in-person interaction. So I completely agree.
You guys are talking about sort of flying around, traveling around, and I guess geography is quite a hot topic. If you were looking to go and raise a fund, go and find some LPs, where are you heading to first and why?
It's America, right? That's that's where almost all it'd be Silicon Valley.
I think this really depends on what's your backgrounds. Because as a GP, when you get in touch with LPs, trust is the most important thing. Like pitching an LP out of the blue without prior context is very hard, and the closing rate might be different than if you're being introduced, if you have some trust, if you have some connection being built around that. And I can tell about like organizing events how connections are built on long-lasting relationships. So I think for a GP willing to raise funds, the best location would be where there is trust being involved, whether it's by mutual connections or actually having maybe, in our case, for example, we're very local, Paris Blockchain Week, it's in the name. So obviously a lot of our LPs are based in Paris, and it's also a chance to invite them, to show them what we can do as well. So the trust components, I think, plays a great deal in how you will locate the LPs.
The good news is there's money everywhere. I think the LP profile that worked for us were people who missed the boat the last time and saw the mistakes being made and want to make sure that you aren't going to make those mistakes again. And you make it very clear to them that you aren't, and this is the strategy that's broken down to do so, and that's why we fundamentally changed the structure of how an early stage fund should look like, so that was a big part of it. And I would say, don't underestimate your background and your pedigree. Dip back into who you are. A lot of our LPs are Hong Kong family offices. because my family's from there. And so you kind of you leverage the trust. The nepotism should be a part of it, right? Like you should be taking advantage of the nepotism. But then over time, merit overcomes nepotism, which is something you can definitely quote me on. But the idea here is you have to find where you have those unfair advantages and can be a qualified and trustworthy voice where they understand. And I'll say this, like the view on VC in certain regions has changed too by the winners from those regions. Right, so as a Canadian as well, you think of the VC wins in Canada, really not a lot to think of, right? But you want to show them, hey, because I've spent the last 10 years in the US, I'm taking the Canadian thinking process with the American returns and trying to morph those things together and see if there's something interesting for them to look at. But I think you can find that capital everywhere. And unfortunately, I'd actually say within Silicon Valley, I haven't seen the interest as intensely, mostly because a lot of them have already had exposure and they will have their access. They'll say, yeah, I already put a check into A60Z. Why the hell do I have to put money into your fund? I'm like, oh, fair enough. Like, I mean, then you're not a profile. Bye-bye. I'm not that rude. But like, point is, like, you want to find people who have not gotten in, aren't as cool enough to call up Ben Horowitz and get, a check in like a few minutes, but rather want to get exposure somewhere else.
Okay, so we're coming into the final minutes. We've seen a lot of things maybe closing down. We saw Split Capital close down after just 2 years of operations. If you're thinking how to future-proof yourself for the next 18 months, what's your one piece of advice?
Future-proof for VCs?
Yeah. Future-proof yourself.
Don't be like other VCs. Right, I think the problem is we are, and I've faced this unfortunately, like repeatedly. Is there's this really bad reputation that VCs have in general, which is not great, and it's also like PE. Like PE is getting poo-pooed a lot in public, right? Like, oh, you guys are the Darth of American civilization, and there's going to be, sort of single-family homes getting taken over, and PE is just like a bad category. There's a lot of these pictures being painted of us that are not the greatest. I think when you're not operating like the rest of the crowd, you will have the luxury of being able to explain why your value is beyond just the name, right? So VC as a name becomes this category where I'm sure when the founders were using their Claude agents to find all the speakers, let's just filter ventures and then just pitch you for the shits and giggles. I'm like, that's not how you're supposed to be doing about it. Like, look at the human and look at the fun and the focus. Think about it beyond just the name and the label. I don't just find you to fund you just because your name is founder or CEO. That doesn't make any fucking sense. Like, I look at your category, look what you're building. So it goes both ways.
Yeah, I mean, I would agree too that a lot of VC, the reputation you're talking about is that they just chase whatever's hot, which is largely true. I mean, that's where our fund is a very, very small, ultra controversial category of crypto called Bitcoin DeFi, which no one really believed in. And so for our LPs, it was a nice sort of, and when they look at their portfolio construction, the check into our fund was about basically, if this category explodes, I need to position my portfolio to where I benefit from this. However, it's ultra high risk, high reward. So that's kind of how they mentally bucketed it. But what's funny is, that's what it should be in a way. It shouldn't be general crypto. And there's a lot of general crypto funds, and I'm like, well, what does it even mean?
Well, this is the barbell that was coming out.
So I agree with that quite a bit.
So I would say two advice. The first advice is don't split yourself between saying you're either strategic or financial. You need to be both. There's no such thing as just a financial VC or just a strategic VC. You need to be both. The other one, again, coming more from the institutional side, is I would strongly advise to stop dividing DeFi versus TradFi. Everything's going to merge. And the smart ones, the ones that will survive, are the ones that will understand that, and you can get a lot of institutional money right now if you have that speech in front of institutional LPs.
Yeah, amazing.
And just to sum it up in a word, I think the crypto meme of the bell curve, where you have the IQ and like the lowest IQ and the highest IQ, the JEDI, being at the same spot, is a perfect explanation of what VCs should do.
Retard maxing, you heard that line,
exactly.
Right?
Just
it's
don't
like
be
retard
mid-curve.
maxing now.
Market juice is all about that.
You can't mid-curve in crypto. That's the only thing.
Retard maxing ventures. Okay,
Always left curve it gets you to the best place. But that's all we have time for. Please give a massive round of applause for the amazing panelists. And again, thank you so much for Paris Blockchain Week.
Welcome to Signal Week.